the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. As we indicated in our lead-in, this is a different take on the investment show. I'm not a licensed professional to sell securities. Instead, I'm a securities attorney who represents investors in claims against brokerage firms. So the objective here is not to provide investment advice, but rather to arm investors with information that I think, based on my years of doing this, would be important for investors to have to even the playing field and make them more aware of some of the tricks that the brokerage industry uses to get you into products that maybe don't make sense for you. And so each week we'll try to dive into some various different topics to pass along that information and go through some of the things that maybe are happening in the market and how that might impact recommendations that you're going to see from your financial advisor, things to be on the lookout for, and hopefully we'll be able to pass along some of that information. If you have questions, please visit our website. It's at wallstreetvmainstreet.com. Send us a question and maybe we'll try to answer it in a future episode. We've got some questions this week, which we're about to dive into. These are questions that I've actually heard from existing clients who were helping in cases against their brokerage firm, and they've just come up and I've jotted them down. But we would love to hear from you, and we'd love to get some questions to the website so that we can tackle those in future episodes. What's our first question?
So I've been watching all of the wild swings in the market recently, and I'm scared it's going to be like 2008 again. I called my broker and asked to go to cash, but he convinced me to stay the course and that everything would be fine. Should I listen to him?
It depends. Yeah, and maybe that's the best lawyer answer that you'll ever get. It always depends, but part of that's an investment question. I don't know if the market's going to go up or down. If I did, I probably would just be playing the market and not helping investors. But what I think is significant about that is to let investors know that financial advisors always say this. I've been through two market corrections thus far in my career, 2001, which is the dot-com crash, and then 2008, which was obviously the Great Recession. And in virtually every instance, you've got clients who said, hey, I told him I wanted to get out of the market. And he said, or she said, no, you got to stay in. Everything will be fine. And the reality is, depending on your time horizon, maybe that's the right advice. We've certainly had corrections through the course of time, but generally speaking, the stock market does go up. So if your time horizon, I'm in my 30s, I don't plan on retiring for 30 years. I probably should stay in the market because the problem, the difficulty is timing the bottom. Timing the market is virtually impossible. So, when do you go in, or when do you go out, when do you go back in? If you had gone to cash in 2008 and waited until 2011 to go back in, you missed it. The market recovered, and you wouldn't have captured that, and you would have sold at a bottom. So, and that's the kind of thing you're going to hear from a financial advisor. And again, the answer is it really depends on your objectives and where you're at. If you're 75 years old and can't really afford any risk, then, well, number one, maybe you shouldn't be in the market in the first place. But if your broker's got you in the market and you're scared that you're going to drop down to a point where now you can't really live on your investments, then maybe cash does make some sense. But more importantly, maybe it's time to reevaluate the portfolio in general, because maybe you shouldn't be exposed to that kind of risk. But in terms of the broker saying, hey, stay the course, everything's going to be fine, that is going to be their stock response. And frankly, they're trained to do that. And there's a reason behind it. Number one is what we just talked about, which is, generally speaking, that may not be the worst advice. It depends on what your objectives are. But the larger part is they don't make any money if you're in cash. And so you have to have that sort of in the back of your mind when you're deciding, when your broker's saying, no, stay the course, stay the course, stay the course. You got to parse through it and figure out, okay, is that the right advice for me or the right advice for them? Because if you go to cash and you just sit there and you're not trading, you're not investing, you're not doing anything, they're not making any money off of you. So that's part of why they might be saying, no, stay the course, stay the course. But the other part, in fairness to them, is that it really depends on what your time horizon is. Because again, if your time horizon is 30 years, if you go out of the market and it bounces back and you don't capture that, you're going to end up way behind. And there's analyses of that that talk about how that can negatively impact the performance of your portfolio over a 30-year period of time. And so, going back to my original response, it depends. It really depends on your investment objectives. But what I want investors to know is sort of you have to keep in mind what's the financial advisor's motivation. Why are they saying that? And the motivation is they need you in the market. That's how they make money. But in terms of whether or not it's the right advice for you, that depends on your particular situation. So, what's our second question?
I keep hearing in the news that China's economy is slowing down. But why would that affect my investment since I only invest in U.S.-based companies?
Yeah, this one's particularly timely just because of the dip that we've seen over the last couple of weeks. We did have the markets enter into a correction territory. A correction is anytime the markets dip down 10% from their peak. And so I think the market peaked earlier in the year, and we've seen sort of this range it's been trading in. But more recently, it did dip 10% from the peak, both in the Dow and in the S&P. And so it did enter into a correction zone, and part of that is because of the craziness that's going on in the China market, where they've had an enormous explosion in their index, and then over the last couple months, an enormous correction, and that has finally filtered over into the U.S. market. But I don't think it has to do necessarily with what's going on with their stock market so much as what's going on with their economy. And I think the reason that you saw that affect U.S.-based companies here is because China is a huge driver of the global economy right now. And certainly it's one of the few growth countries. So if their economy slows below expectations, you are going to see that predominate throughout the entire global market. The reality is it's a shrinking world, and very few companies don't have some China exposure. The largest of our, Dow companies, our S&P companies, are all trying to capture that growth market in China. Look at Apple. Apple, has huge market share in the United States. Where are they going to grow? They want to grow by capturing the middle class that's coming out in China right now and selling them iPhones. And so if the China economy slows down significantly, you're going to have fewer people who are in a position to buy iPhones, and that's going to hurt their bottom line. And you've seen that in their price. I think it was around $126 a share in mid-August, and now today it's trading substantially below that. And that's part of the reason. You've got these companies. The world's more interconnected, and it's more difficult to say, hey, I'm a U.S.-based company, and the U.S. economy is doing great. There's no signals of slowdown here. Why is my stock price down? The reality is most companies are trying to sell stuff in China, or maybe they get goods from China, or maybe, collaterally there's going to be some impact. And so that's why you've seen it impact our economy. But at the end of the day, it seems like the U.S. economy is doing well. And relatively speaking, the China market's down 30-40%. So, for us to enter into correction mode, which is just 10%, still better than how they're doing. What's our third question?
What product should I be concerned about if my broker is recommending them?
Generally, every investment has a time and place. So, I can't just say, hey, it's variable annuities. If your guy's selling you variable annuities, that's wrong. Or, non-traded REITs, or, some of the types of private placements, or some of the types of investments that we see. Because if there is a time and place for every investment. So let's say, variable annuity being an example. Broker wants to sell you a variable annuity. You've got $2 million portfolio, and they want you to do a $100,000 investment in variable annuity because it'll provide a death benefit that'll be able to pay for funeral costs. That might be a great idea. That might be exactly what you need because you don't want to have to worry about your spouse dealing with it or coming up with the money, or maybe there'd be some tax implications of drawing it out of a different account. So that can make complete sense. Whereas if the same situation, same investor, $2 million portfolio, now you've got a financial advisor that says, hey, let's put your entire $2 million in a variable annuity. That may not make any sense. That might be a huge overconcentration. Maybe they're doing it because variable annuities do pay a higher commission than some products. And so that would be a situation where there's some red flags there, and I'd want to peel the onion further to figure out whether or not that recommendation makes sense. So again, generally it depends on what your situation is and how much of the portfolio it is. But in terms of takeaway, what are the red flags? What should you be looking for? What I would say is anything that sounds too good to be true. If you've got an advisor in this climate where there's very little yield, who's trying to sell you a bond that pays 9% and he's telling you it's conservative, he's wrong. Treasuries are paying 2%. Corporate bonds are paying like 3%. The reality is if you're somebody who's trying to sell debt to raise money, you want to pay the lowest rate possible. And if you're paying 9%, it's because no one would buy it at 8 or at 7 or at 6. So you have to keep raising the rate until somebody's willing to buy it. And usually the reason for that is because you're seen as more of a default risk, which is why treasuries are at 2. That's like the gold standard. We've never defaulted on our debt. And that's why people are willing to take a lower yield to hold that investment. So if you've got an advisor who's saying, hey, I've got this great product, it's paying 9%, no risk, it's just like treasuries, it's just like CDs, whatever the representation might be, that's too good to be true. That's probably, and that's not a specific investment per se, but that's something that you should be worried about. If they've got something where it's a promissory note backed by this and it pays 10%, whatever, again, if it sounds too good to be true, then it generally speaking is, and that's what you should be worried about if your advisor is recommending something. The other thing to watch out for are any of the investments that are high commission, because you just get into that inherent conflict of interest where a financial advisor might be recommending it because it's in their best interest as opposed to yours. And while there is a time and place for virtually every product, that to me is a red flag. And that's, usually what we're seeing are cases where the broker over concentrated a portfolio in a product that paid them, between 5 and 7%, when there were other alternatives that would have been equally as suitable or even, more suitable for them, that would have paid the advisor a much lower commission. And so, some of those products are private placements, non-trade REITs, oil and gas limited partnerships, tenant in commons, which are real estate deals, variable annuities, which I mentioned, or variable universal life policies. Those are usually in the 3 to 4% range. That's a little bit lower, but we definitely see advisors who, recommend those inappropriately. So you have to be careful with those. But mostly you just have to keep in mind that there is a direct correlation between risk and return in investments. And so if your advisor is telling you, oh, it's got this huge, we're going to make 15%, and they're saying there's no risk, that's a disconnect. That's impossible. If you've got a huge rate of return, then you're probably accepting more risk. And maybe that's okay with you, and that's different. But if you're a conservative investor and your advisor is saying, hey, this is super conservative and it also pays 15%, that doesn't make any sense. And so that's something that you should be on the lookout. I mentioned it earlier in terms of an example, but we're seeing that a lot right now with debt for oil companies. We've got the fracking companies in North Dakota and Colorado and Texas, and a lot of them funded their operations through bond offerings, and they're paying 8.5%, 9.5%. And obviously with oil prices where they are right now, they're at great risk of default, which is part of the reason they had to pay that huge percentage. But certainly if there was an investor out there who was looking for some yield, and yield's hard to find right now. And if you're a retired investor, you know it. Maybe you're retired and you wanted, 4% on your money, and that's very difficult to find without some risk right now. But if your advisor called and said, hey, I've got these great bonds, it's this oil and gas company, and they've got great drilling rights and blah, 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 and it pays 9.5%, very conservative. It's not. A lot of those companies are going to end up defaulting. You're going to see a lot of mergers and acquisitions, I think, in the oil and gas space coming up here because not a lot of these companies can make it. The banks are getting ready to reevaluate their loans. I think October 1st is the deadline for that. And a lot of them are going to get squeezed. And in my experience, when you see companies declare bankruptcy, the ones who usually take it on the chin are the bondholders, bondholders and pensions. That's something that would be of concern. But again, it all harkens back to the main point, which is if it sounds too good to be true, it is. If you've got a bond that's paying 5 times treasuries in an environment where there's little to no yield, it's not conservative. So just keep those things in mind. And I think that's all the time we have for questions. We're going to cut to a break with some commercials here. When we come back, I'm going to dive into some more war stories, types of cases that we've seen in our practice to give you some idea of red flags, things to be on the lookout for.
Why Agua Vida Services? Because you want a safe, sanitary, and energy-efficient pool in your backyard. Rediscover your why and get back in the pool of your dreams. Agua Vida Services is a state-certified pool renovation expert with over 13 years in business in Vero Beach. Let Agua Vida Services help you get in the swim again. Agua Vida Services, water for your life. 7940586, part of the iTex trading community. Your iTex dollars are welcome.
When you pay too much for your stuff, you get frustrated. When you get frustrated, you eat junk food and watch reality TV. When you eat junk food and watch reality TV, your clothes don't fit and your friends stop calling. When your clothes don't fit and your friends stop calling, you get depressed, adopt 27 cats, and paint your house plaid. When you adopt 27 cats and paint your house plaid, your neighbors report you to the authorities. Don't get in trouble with the authorities. Shop at the Habitat Home Center Restore, where you can get all sorts of stuff for great prices. You can also donate your stuff and we'll pick it up for free and give you tax credit documents. So you can shop, donate, or volunteer at the friendly, bargain-filled Indian River Habitat Home Center Restore, located on US 1 North in Vero Beach, just past 45th Street East Side. Phone us at 772-257-0222. 772-257-0222. Habitat Home Center Restore is a not-for-profit.
1-800-HI-MITCH. What's that number and who is Mitch? 1-800-HI-MITCH is the number for Mitch Maxfield's Carpet and Furniture Cleaning Services. Serving Florida's treasure and Space Coast for over 30 years, and Mitch still does the work all himself. Call 1-800-HI-MITCH. Mitch Maxfield personally will clean your home or business. Call now for 2 rooms of carpet cleaning for $77 or a 6-foot sofa for $66. Maxfield Carpet Cleaning is a member of the iTex trading community and welcomes your iTex dollars. 1-800-HI-MITCH.
Welcome back to Wall Street versus Main Street, a different take on the investment show. I'm your host, Dax White. I'm a securities attorney. We represent investors in claims against brokerage firms. So the objective of this show is not to give investment advice, but rather to provide, sort of my background, things that I've seen in the industry that I wish investors knew before they embarked in a relationship with a financial advisor. Before the break, we did some questions. In this segment, we're going to talk about some war stories, things that I've seen, just to provide some color on the types of stuff that's out there. Again, the brokerage industry is not unlike any other industry where you've got good ones and bad ones, and unfortunately, we see the bad ones. But certainly, if all investors had the information that we had, I think that you'd have situations where as soon as you realize that your broker is making your recommendations inappropriate, you could shut it down, fire him, and hire somebody else. So, the types of cases that we generally deal with, we talked about a little bit with that last question before the break, generally has to do with this nexus between commissions and greed, where you've got a financial advisor with a very short-term model where they try to make a huge upfront commission that is in their best interest, but not necessarily in the best interest of the client. And usually that's sort of the motivation. And then from there, you get into various types of products and, different goals of what they're trying to accomplish. But that's usually the nexus of it. And whether it's negligence in terms of the portfolio that's set up or outright fraud depends on the particular case and that particular broker. But usually commissions is at the heart of it. That's there's a huge range in terms of the types of products that financial advisors can sell. All the way from bonds where they can make a couple $100 to private placements where they can make thousands and thousands of dollars. And if you've got a financial advisor who's a bad financial advisor who's looking out for himself first and foremost, that's usually where they're going to steer you. They're going to steer you to the highest commission product that's out there and tell you that, oh, this is great and suitable for you and it's going to do wonderful. And maybe they hope it will, but the underlying problem is that conflict of interest that they have in making a recommendation that pays them more. In terms of war stories, one that I think about a lot because we had a number of clients involved in the situation was a financial advisor up in Michigan a couple of years ago, where he went into a large Fortune 500 company and convinced, I think we had between 20 and 30 investors that fell into this category, but he convinced all of them to take their lump sum pension benefits rather than a pension for life that would have paid them monthly. He convinced them to take the lump sum. I think the pension benefits were going to pay them between 5 and 6% of what the lump was for life. So they would have gotten, depends on how long they'd been with the company, et cetera. But let's say it was $1,500 a month for as long as they would live. Rather than do that, he convinced them to take it a lump sum, and I'll put you in a variable annuity that'll pay you 6%. So slightly more, a little bit more bang for your buck. So, you'll have a better quality of life in retirement. And so he got, like I said, a ton of investors. I mean, we represented between 20 and 30. I don't remember the exact number, but there are undoubtedly more of them out there. But he convinced all these people to do that, buy this variable annuity that unfortunately did not do what he said it did. His representation to the investors was that it would pay a guaranteed income stream. And while some variable annuities do have that feature, it's a specific rider that you have to purchase, and it's very expensive because from the insurance company's standpoint, if they're required to pay this out every month, the market's not always going up. So, in downward market, they've got to factor that in terms of the cost. But for this particular individual, none of the investors purchased that rider. Instead, the feature that he sold them on, he told them it was a guaranteed income feature, but the reality is what it was is a guaranteed growth on a death benefit, which is entirely different. So if you invest $500,000 into a variable annuity and it had a guaranteed death benefit increase of 6%, that means that in year 2, if you passed away, you'd have $530,000 guaranteed. But that's not what these people needed. They were retiring and planning on living on this lump sum. And the reason the feature didn't work is because that only paid out in a death benefit. But if you were withdrawing from the annuity, that eroded the death benefit feature. You're never even going to see that, which didn't really matter to these people because what they needed was income to live on. And so basically they eroded their policies, and by year 4 or 5, they were worthless. And they thought throughout this time period that it was what they were spending was the growth that he promised them. Again, if you've got a $500,000 annuity and you think that you're getting guaranteed 6%, then you can comfortably spend $30,000 a year and think you've still got the 500. When in reality, what they had was 470 minus, a time period in the market when the market was actually going down. So the underlying investments in the annuity were going down. And so it was substantially less, and they'd call him and he'd say, oh, let me talk to the annuity company and get that worked out. There's a problem. But he led these people to believe this for a long time. And unfortunately, you had a lot of people who were losing their homes, unable to pay bills, living on Social Security only. It was a very sad situation, but that's the kind of stuff we see. We're running out of time, so I'm going to wrap it up there. If you've got questions or you just want to touch base, check us out, wallstreetvmainstreet.com.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.